All right, okay, I'm back. Thanks for watching this video. My name is Jim, 26 years in retirement planning. I'm going to start with a little show and tell here. Let's imagine you're thinking about retiring sometime in the future, maybe soon, maybe later. I'm going to give you an example mathematically of the incentive to start today versus starting tomorrow. So we're going to call you a planner. We're going to turn this upside down. And in the course of this video, we're going to come back to this demonstration and I'll show you how mathematically it behooves you to start planning for your retirement sooner rather than later. All right, so the title of this video is How Interest Rates Can Save Your Bacon in Retirement. So there is an opportunity, despite the negativity in the press with the stock market, the price of oil going up and the stock market declining significantly over the last month or so. And I'm going to share with you how insurance companies get around this problem because they're very unique institutions and they offer these insurance contracts called annuities, which can be very, very confusing to most people. I've been doing this a long time, so most of my daytime is spent explaining the nature of the annuity contract that you might most be interested in. So I'm going to cover that real briefly in this video. The idea, of course, behind retirement is that you're going to give up something. That's your salary. So how are you going to get a salary after that so that you don't have to change your lifestyle too much? So this video will deal primarily with income-oriented annuities, but there are other types of annuities out there we can discuss later as well. So replacing your guaranteed income from retirement, from a salary with income in retirement. Now there's three institutions out there. There are banks, there's investment companies, there's insurance companies. Banks, you run a high mathematical risk, of course, of running out of money. Investments are not reliable from a guaranteed income standpoint. Only insurance companies actually sell these particular products called guaranteed income. So everything of value has to be protected somehow with an insurance contract, an insurance policy. So insurance companies are very unique. They're not investment companies and they certainly aren't banks, but they are designed and regulated at a state level to protect something that's very, very sacred to you. So if it's your health, your home, your car, you have to have an insurance contract, you have to have an insurance policy to protect you when you need to replace those things or fix those things, right? Now, when it comes to money, believe it or not, the insurance industry also can protect your money, but they do it in a variety of different ways. They can protect your principal, they can protect your interest rate, your fixed rates, if that's what you're choosing. They can protect the benefits that go to your heirs. They can protect you if you get sick for long-term care. There's a variety of other protections not mentioned here, but we're going to cover the idea of protecting your income in retirement. And the thing about insurance is it has to work, otherwise insurance companies couldn't sell it and you wouldn't buy it. So insurance companies are super sensitive to making sure their products will work, and state-regulated insurance departments are super sensitive to regulating these insurance companies so their products do work. When it comes to income guarantees, this is where it gets confusing because for a lifetime you've been investing your money and now you're going to go to an insurance company and it's just completely a different paradigm shift for most people. And I'm going to hopefully undo that in this brief video here. So the difference between investing in the stock market when it comes to your income and retirement versus an insurance company is this. Obviously, you invest your money in the market, hopefully to get returns and dividends that you can live off of. Now, of course, those income that you receive from the stock market is not guaranteed. So you can always take your funds out, hopefully without a loss before the market crashes, but you can certainly take your money out. It's fairly liquid. With insurance companies, it's a little bit different. You can still give your money to an insurance company. Now, with an insurance company, the income is guaranteed in the form of a contract that you receive, a policy in writing that you can get it in advance, if you like, even before you make your deposit or your premium payment to the insurance company. But what's interesting about insurance companies, which most people don't understand and most insurance agents don't convey to their clients, is that the income guarantee from an insurance company acts very much like a bank loan. Now, it can't be called a bank loan because it's a completely different industry, but it acts and behaves very similar to a loan from a bank. And you can always give your money to an insurance company and you can always get it back if you want to. In the case of an insurance company, you're not going to have a loss of principal because of the market going down, but you could incur a penalty depending on when you take your money out of an insurance contract. So the question might come, if this product acts like a loan, well, why? What are the terms of this particular loan idea with an insurance company? Well, let's just take a quick basic foundational level look at loans. So car loans. If you want a car, obviously it's valuable. You have to have an insurance policy on your car. So you're going to borrow money to go buy a car. You're going to get that money from a bank. And the question you obviously have to recognize is the funds are coming from a bank to you to buy the car, right? So you're the borrower and the banker is the lender. Same thing with a house. You're the borrower, the banker is the lender, and the money's coming from the bank and going to you to purchase the house. Now, what is really fascinating is in the next slide, I'm going to share with you how things are completely flipped when it comes to insurance companies and annuity contracts. Because in this case here, obviously, you're trying to borrow money at the lowest possible rate, right? Well, what happens with insurance when it comes to a guaranteed income? We know only insurance companies will give you a contract or a policy to offer you a guaranteed income in retirement. So you can't rely on your stockbroker for that, and you certainly can't rely on the bank because you're going to run out of money. So you go to an insurance company because they have this thing called guaranteed income in retirement where you can basically have a salary after you retire. It's very, very attractive. So here's the $64,000 question, which nobody seems to recognize, is where is the money coming from in this case? Is it coming from the insurance company? No, it's not coming from the insurance company. It's your money. You're giving your 401k, your IRA, your TSP, your bank CD, your savings, whatever you have, you're giving it to the insurance companies. So the script has been flipped entirely, and nobody recognizes this, which is really quite fascinating. So you're not the borrower, I can't even say that word. You are the lender. And the insurance company is essentially borrowing it from you, aren't they? And they're going to pay it back to you over the term that you choose. So if you chose lifetime income, they're going to pay it back to you based on the prevailing interest rate at the time that you loan the money, essentially, to the insurance company. So the question comes down to, if you're making payments, high payments for a car loan or a home loan that you borrowed when rates were high, shouldn't the insurance company also be obliged to make high payments to you when they took your money, or borrowed it, I guess you could say, at high rates also? Of course they should. And so nobody recognizes this, and this should change the way you feel about an annuity contract or an insurance contract that is guaranteeing you an income in retirement. Because your incentive, obviously, is to, quote-unquote, lend the money. Remember, we can't call this a loan because it's an insurance company. It's under a different legal structure. But your incentive, since these policies essentially behave like loans, your incentive is to loan this money out at the highest possible rate. And guess what? We're at a very healthy interest rate environment. And if you are able to think about insurance as being a highly regulated industry that doesn't leave people hanging. I mean, I've been doing this since the late 90s. I haven't lost one penny ever. None of your securities investment advisors can say that, of course, because they've sold you investments in the stock market, which is not guaranteed. But I can say that. It's much more comforting to think of your funds with an insurance company regulated, where bean counters in the state Department of Insurance are making sure these insurance companies are able to honor the promises that they've offered you. It's much more comforting to know your money's this protected in this fashion than where it's an investment where your income is not guaranteed, right? So why don't they just call these things these annuity contracts loans in this case? They just can't, because banking and insurance are completely different businesses. They're regulated under different state laws versus banking laws. You have different rights with an insurance contract than you do as a borrower from a bank. And there's just different laws with obligations between insurance companies and the banks, which is more than this video can unfortunately cover, but I can create a video on this. So the question comes down to is, when are you going to make your loan, so to speak? I say that in quotations because these are not loans, even though they act like loans. Are you going to do it when rates are high or when rates are low? Well, it's kind of a no-brainer. So let's cover this, because I want you to understand, if you decide not to get your annuity contract when rates are high, what it might cost you if the interest rates are different. So the interest rates are so important that it almost makes the yield somewhat redundant, or secondary, I should say, on your portfolio. So let me show you what I'm talking about here. So let's imagine you're my age, you're 60 years of age, you're going to retire in 12 months, and you're getting a quote from your employer that they're going to give you an annuity payment of $43.51 a month if your balance in 12 months is $750,000, because that's what you're hoping it will be. So the current annuity rate, for example, with the Thrift Savings Plan, which is a federal employee plan that's offered through MetLife, called the TSP plan, it's paying 4.58% today. Today is March 28th. and the yield required for me to get from 700 grand to 750 grand is 7.14%. So all things being equal, if the interest rates are the same in 12 months, then I should get 43.51 if I have a balance of 750 grand. But the interest rates are so powerful. Just imagine if they dropped by about 1 point to 3.58. I need not 750 grand, I need $820,000. That's a 17.22% return. Highly unlikely to get that in this current world that we're living in. If the interest rates drop another point, now I need almost 30%. I have to get up to 900 grand in 12 months just to get that same 43.51 a month, and so forth and so on. And if you think these interest rates can't drop this quickly, I'm going to share with you that it's very possible that they can. So if you go to any of my websites, safemoneysinger.com or fedfinish.org, I've got links to the actual historical TSP, the Thrift Savings Plan, which is very similar to how most annuities operate off the 10-year Treasury rate. But you can see the last 3 years, the interest rates have been very, very good. As you all know, they've gone up last 30 to 36 months or so. But from 2023 back to 2009, they were all lower. So it's very possible that if you do want to delay your purchase of your annuity contract because you're not going to retire for 10 years, mathematically you're taking a significant risk, aren't you? Because even a lot of money is not going to pay as good as lower money with higher interest rates. And let me share this with you in a different fashion. So this is also on my my website, Safe Money Singer and fedfinish.org. Here's the same example of somebody my age that's going to retire in 12 months. They are guaranteed 43.51. That's just over 50 grand a year. 25 years of payments, $1.3 million guaranteed in writing from the insurance company. But once again, if the interest rates go down by the time I was to purchase this annuity, which in the case of the TSP can only be purchased on the day that I retire, and the interest rates are 3.5%, that's going to cost me over those 25 years $111,000. Similarly, if the interest rates are 2.5%, when I actually retire in 12 months, it's going to cost me $209,000 of less income. So the interest rates are actually a counterintuitive component to the way we think, because we all think that having more money is going to save our bacon, when in reality, when it comes to a safe, contractual, guaranteed income, you need to go to an insurance company to get that. And insurance companies are very, very sensitive to the interest rate environment, and they're very powerful when the interest rate environment is high. You can actually have more money but get a lower salary because of the lower interest rates when you buy your annuity contract, and have less money and get a higher salary because the interest rates are higher. So from a guaranteed income standpoint, you don't need as much money. And guess what? If you're not going to retire for 10 years, for example, you can still buy your annuity today, lock in a high payment that starts at some point in the future, and then with all your contributions and savings from now till retirement, you can buy another annuity contract and really lock in high salaries at that time as well. So obviously that's a pretty much a no-brainer in terms of buying your annuity when rates are high. Are you going to buy the annuity now, before, during, or after the market correction? That's kind of a no-brainer as well. If you're bullish, you're one of the rare people that thinks the market's going to come zooming back anytime soon, you can obviously stay the course, and you can also take your chances with future interest rates, as well as taking your chances with market declines. But if you're bearish, like many people are today, insurance is very, very popular. Annuities have never been more popular. You can lock in your gains, all your earnings, and lock in these high interest rates, lock in future income guarantees, lock in principal preservation, lock in high interest on principal if you want, and you can always make contributions to further income guarantees down the road. So what if you're not going to retire for another 10 years? How does this work? So you can still use the same maxim that you're going to be loaning your money, quote unquote loaning, because it's not a loan, even though it acts like a loan. You're going to send this money to the insurance company while the interest rates are high. This rule does not change even if you're not going to start income right away. It obviously is self-evident if you're starting income right away, but it doesn't change if you're going to start income down the road. And in fact, the benefits even get better because the insurance industry essentially rewards you for starting early, buying early, and starting late. And you can think of that in terms of life insurance too, how life insurance is very inexpensive when you buy it in your 20s, but it's much more expensive when you buy it in your 60s, for example. So this is called the power of deferral credits, often suggested to be mortality credits, but actually deferral credits are different than mortality credits. So I'm going to show you salaries that are available to you. And this is assuming you decide to start income at various different time. So if you had $500,000, the insurance industry will give you what's called a roll-up rate or a step-up in the income guarantee column. So this is not necessarily principal. This is strictly a calculator used to determine your income. And the insurance companies will have these rates at 8, 9, 10%, for example. And they give you these guaranteed ledgers in your policy. And then they have what's called a life expectancy factor or a payout factor. So for example, if you were to start your income in this case here at age 68, but you bought your annuity at age 60, the insurance company, and I ran these numbers just yesterday, March 27th, 2026, the insurance company in this case will give this person who bought this annuity at 60, $72,000 a year. Now, you decide when you start your salary because you buy the annuity today to lock in a future salary, but you don't have to make decisions. There's no obligation. There's no contractual obligation for you to start your income at any particular point in time. You just get these guaranteed increases on your income. So in this case here, if this person was to start income at age 68 and live to 85, they would get back $1.231 million in writing, guaranteed in advance of income and salaries. Very attractive. Where can you get this? You can't get this, unfortunately, on a guaranteed basis from your other portfolios, that is. And just so you recognize the nature of insurance versus how Social Security works, they're both using actuaries. They're using the same actuarial principles to determine these salary increases because as your life expectancy goes down, the insurance industry, which is basically a timekeeper for a human life expectancy, has to give you more money based on the time that you've passed with where you've given them the money in the past. They have to give you a higher salary, obviously. All of this is given to you in advance, by the way, in your policy. So let's use an example, real world example of a couple age 60 and 55 retiring in 10 years. They get their estimate from, in this case, the Thrift Savings Plan, which offers an annuity contract through MetLife. And I just ran these numbers a couple days ago as well, and it comes out to 61.55. Now, there's two huge caveats with these estimates that you often get from these plans that are offered, in this case, by the federal government. The exact same interest rate environment must exist in 10 years for this to be true. The mortality tables and the pricing of the insurance company can't be changed as well, just to make this accurate. And they have to get to that $1 million. Now, in this case here, they actually have $700,000. So if they decide to buy an annuity today, guess what? With their $700,000 today, based on these interest rates and based on a 10-year deferral and all the roll-up rates, an insurance company somewhere is guaranteeing them right now to start in 10 years a payment of $8,771. That can't be changed due to the market crashing or to the interest rates crashing. And that's $784,000 more than what they're currently being proposed to by their company pension plan. So these annuity contracts are not dependent on the future market yield. You still have potential growth in the contract, believe it or not, but the income guarantee is not going to be dependent on whatever the stock market does. It's not dependent on the future interest rates because once the annuity contract is purchased, the insurance company goes out and buys all these investment grade bonds at the current interest rate environment, which obviously are going to pay back to you the income at that interest rate environment when you bought your annuity. It's quite complex, but quite simple at the same time. And this, of course, doesn't take into account further contributions that you might make towards your retirement in the 10 years that are coming up here. So interest rates are super powerful. You buy them when the rates are high, you're out of the market, and you get deferral credits by the insurance company. So, these concepts are not necessarily easy to grasp because there's a variety of issues at play here. We're all conditioned to think that a bigger pile of money is the way to go. But when it comes to guarantees, unfortunately, or fortunately, we have to go to insurance companies, and insurance companies actually pay higher salaries on a guaranteed basis for less money. And this is called investment consciousness versus income consciousness. And to go from one to the other is not an easy thing to do, obviously. And the other challenge, of course, is your stockbroker and your investment advisor for years and years and decades has said to you, you have to keep investing. It's the only way to go. And whether or not that is unbiased, transparent advice, I'll let you decide. But the Wall Street stock market industry survives on what's called trail commissions, which is obviously when you keep your money with an advisor, they make money every single month on your funds. And that's how the business works. So everybody's got their own little bias, I suppose. Even myself, I'm an insurance agent. We get paid one time to offer these products. So we all have our biases for sure. And unfortunately, a lot of annuity agents that sell these plans often portray these devices as investments as well. They're not. They're contracts with insurance companies. And so it's not easy to understand these concepts, that's for sure. So let's get back to our hourglass here. Okay, so now I'm going to bring back our hourglass example here. And on your right, my left, is the planning individual, somebody that took advantage of this video and said, I'm going to set up my retirement. Everything you see in the bottom half of this hourglass here is a salary that is timeless. It's never going to stop until both spouses pass away. And each of these grains of sand you can construe as being an income credit that's already guaranteed in advance. Now over here, we have somebody that decided to wait until his retirement day. He never did any planning beforehand. So now he's going to turn his or her hourglass upside down, which is fine. At least he did something. He's going to get some guaranteed income. But guess how big the salary is compared to the person that planned 10 years ago versus the one that just started. Now, this is a rather esoteric and possibly convoluted example, but if you're looking for a salary in retirement, you definitely want to be this person. You don't want to be this person, because if you're this person, you've got to somehow manage your money for the rest of your days so that you don't lose it. If you're this person, you have a contract that never stops. Okay? So I wanted you to see that. Let's go back to our slideshow here. All right, well, thanks for watching this video. I know these are trying times for everyone. There is opportunity, of course, with a good insurance company with good interest rates to get good income and have a secure retirement. So I look forward to helping you. My name is James Alden, and you can find me here at all these websites of mine. I've been in the business since 1998 out of Southern California. And here's my phone number. Just text me, email me, call me, and I'll send you a really comprehensive video quotation of what your retirement actually can look like on a mathematical basis so you can feel good. Thanks for watching. Take care. Bye-bye.
Thanks for coming to the home where you shop for a safe place to put all the money you got. And if a sleazy salesman has thrown you a zinger, you can always come back to the Safe Money Singer.